Hello, and thanks so much for joining in. You're watching Profit Insights, and my name is Alex Matthew. In the mutual fund space, there are a few mutual funds that stand out in terms of the kind of growth that they have managed to achieve over the past year and a half to 2 years. And one of them stands out in particular, and that is Quant Mutual Fund. It has seen a rapid increase in assets under management, and it has also helped that its mutual fund schemes are among the top performers in quite a few categories. Now, of late, however, there are a few questions that have been raised with regard to regulatory issues. Of course, towards the end of June, you had a SEBI investigation that came to light, and the fund house has said very clearly that it is collaborating, it is sharing data with the Securities and Exchange Board of India, and it has been transparent. To that end, we've got Sandeep Tandon, the founder, the managing director and chief executive officer of the fund house, joining in to talk about some aspects and also talk about how markets stand at right now, what his strategy is and what his team's strategy is. Sandeep, thanks so much for taking the time, and pleasure speaking with you.
Yeah, thanks for inviting us.
Now, I understand that several aspects of this SEBI investigation can't be spoken about, Sandeep, because this is, of course, an evolving situation. But there's one thing that I want to get clarity on, which is that an FAQ was sent out to unit holders at the end of June, in which the first question said that it was a regular investigation. And then a few days back, there was a corrigendum that was sent out to those same investors or unit holders, where it said that it's not a regular investigation and it is in fact a search and seizure, which the interpretation is that it is more significant, it is more serious. Why was there a difference between those two communications?
I tell you, first of all, we generally as a policy don't want to comment on some of the regulatory aspect. Okay, whatever comments was required from term of disclosure, we have given. Our compliance and the legal team felt more clarification was given because some queries were there. We have given, and we don't have to add anything beyond that because related to regulatory, we generally don't want to comment on that. And we have shared whatever was need to be shared with all the investors in a very transparent manner.
Okay, fair point. And of course, we'll see where this goes going forward. The question is, and some of your investors and unit holders will also be wondering, have you had to deal with redemption pressure? What is the kind of selling that you're seeing? And I'm guessing based on the kind of data that you've shared, it's quite comfortable.
Yeah, we had some redemption in the initial. In fact, to be very candid with you, we started accepting public money in September 2020 onwards. And since then, I don't think we have any single day redemptions. Okay. So I think investor has really liked us, the way we have managed their money and the return, the superior risk adjusted for returns which we have given. So they have been with us for, that's the reason this family has grown to now 80 lakhs investors or 80 lakhs folios we have. So we have not seen any sort of pressure in the right from before many years. But yes, after there any noise come or any clarification come, is bound to happen some small. For a few days, there was redemption. But if you really look at last 3 weeks, now this episode is over, and we have seen hardly 600 odd crores outflow, which we have seen. And last 2 weeks has net inflows. Okay, even yesterday also we have net inflows. So I don't see it was a few days phenomena which happened. And now life is back to normal in terms of the way activities used to be. Businesses anyway was always normal. It was never impacted even for a day.
Sandeep, would I be right in understanding that you more or less used cash to deal with these redemptions, since it was a relatively small amount?
You have to understand, we anyway, when this episode happened, we have nearly 10,000 crores of cash in our overall portfolio. It's not so we didn't have to raise anything, and the redemption was not that meaningful, okay, which market anticipated. In that proportionate, it's hardly anything. So in 3 weeks, if you have lost 600 crores, which is less than 1% of your AUM or 0.9% of your AUM, it's not very meaningful numbers. See, you have to understand that the way we manage our money is very different from the industry. Most of the schemes have hardly any exit loads. Okay, for 15 days exit loads, most of the schemes have, which means the way we manage money, our portfolio has to be liquid. Anybody can participate and any can exit at any point of time. We don't take very large load factor or the exit loads, which we will talk about, and lock-in period for longer period of times, which is not the case. So anyway, our portfolios are fairly liquid. That's the way we manage money. Since we are largely analytic firm, apart from valuation analytics, we do give a lot of weightage on the liquidity analytics. If we understand the liquidity of the markets and the global economy, then we do analyze our own liquidity also. So portfolios as a strategy are always going to be very liquid.
Uh, am I correct? I was looking at some data. It was saying that about 2% of assets under management for the fund house as a whole in cash. Is that wrong, or is that more or less accurate?
2% of the fund house is in the
Yeah,
cash.
yeah.
It could be even higher. We generally keep 4-5% cash for any opportunity, not for any specific thing. So, like as I always say that we always have very large amount of cash because we are opportunist. We don't mimic indices. So we are active money manager. We take the fees of active money manager, and we don't offer quasi passive products. Okay. And that's one of the reasons why active managers globally have, the relevance has getting lost as compared to passive manager, because everybody is offering, taking fees of active manager and offering passive product. We are true active money managers, and we do keep good amount of cash at any given time because we are very opportunist. We are unconstrained fund house, style agnostic, market cap agnostic, sector agnostic. Whenever we see any great opportunity and we see superior risk adjusted opportunity is there, we tend to participate. Is only can participate if you have a cash at given point in time. So 5-7% cash is a very normal thing which we keep in our portfolios.
Okay, understood. So I'm actually curious about that portfolio as well, and we'll get into some of those aspects as well, Sandeep.
Yeah.
But before we do, the last time we spoke was immediately after the introduction of this stress test. And you spoke about highly liquid portfolios, and there have been some comments about your recent result versus the previous one, where the number of days has gone up. If I remember correctly, the last time we spoke, you said that it's not necessarily a very clear indication of the liquidity of the portfolio. Can you explain, though, how this works?
You have to understand what it is. First of all, that calculation, what regulator has told, it's obviously capture the daily volumes. So you are looking at the percentage of volumes. So as when market becomes slightly illiquid, your average volumes will going to bound to fall. And if average volumes were bound to fall, then by any your report card will look marginally bad. It's not only for us; it's the case for the entire industry because this is everybody uses the same number. Okay, so it's bound to happen if market, let's say, going forward become even more illiquid and the impact cost moves up sharply. These numbers can deteriorate a bit more. But what happens? You can again, this number has no relevance if you look in isolation. Okay, have to look at it in totality. And as I said, our totality, our today are like 54-55% portfolio is fairly liquid. Okay. And when I'm talking about is a large cap and cash and the gold or silver or ETFs, which we have, apart from our mid and small portfolios are fairly liquid. So it's a continuous exercise. See, I tell you, the way you have to rebalance and manage your portfolio, ultimately you have to generate alpha also. If you just keep everything in a very liquid names, the probability of making extra alpha will not be there.
Yeah.
So it's a fine balance which is required based on the risk on and risk off environment. And accordingly, we do take those calls.
Yeah. I'm curious about, so let's get into the portfolio strategy as well then. And I've primarily been looking at, Sandeep, your small cap, mid cap, and your active fund, which is your flexi cap fund. And I'm just curious about what the factors are telling you, because as I understand it, your fund house looks at factors to determine buy and sell triggers, correct? So what are those factors telling you about where valuations stand, for example, right now, and what pockets of opportunity do they exist, or are the factors completely out of whack right now?
So let me just clarify, we are not factor-based house.
Okay.
We don't look into any of the factor. The factor-based thesis, we think is a bogus thesis which has failed globally. Okay. And that's a factor-based models are part of a very static style of money management and which has failed miserably. So we brought the concept of dynamic style of money management because we believe we live in a dynamic world where data points are changing on minute to minute basis. Okay. And in that background, your money management style cannot be static. That's one of the reasons why we have been relatively more successful, because our practice of dynamic style management has generated superior risk adjusted return on consistent basis. If you look at 6 months, 1 year, 2 years, 3 years, 5 years, And this is like what we have done in last 5 years. Our risk-adjusted returns across all categories where we operate, we are actually by far either we are in the top quartile or we are the leader in that category. So that's the way this organization has been built, more from an analytic perspective. And we very proudly say we are in the business of risk management. Returns are byproduct. So the way we manage risk is all about that, So risk assessment and managing risk is very important. Otherwise, a lot of people end up in doing, oh, that was the risk on period, oh, that was the risk off period. After the event is doing postmortem analysis becomes very easy. So we bring the concept of predictive style of money management. We work on a predictive analytics where we try to connect the dots. And so we run complex multivariance model and we subscribe a lot of data. So when multiple data is skewed on one side, we do take aggressive call. And when multiple data is not giving me any meaningful conclusion, we lie low. It's not necessary that you have to play on the front foot every time. Depending on the environment, we have to change our strategy. So it's like, yeah, go ahead.
Yeah, so what is that? And okay, so thanks so much for the clarification, but what is the analysis point to right now? Because if you look at commentary across the board, seemingly it's getting harder for money managers to find value and to find opportunities to buy. I look at the construction of your portfolios in small, mid, and in the flexi cap, and there is the usage of the space that you have to buy large cap. There are large holdings that you have in the large cap category. So is the interpretation that you're seeing less value in the broader markets and you're moving your assets accordingly?
It's not the case. Actually, this sort of portfolio is there for last many months or maybe few quarters. So it's not fair to say it has just happened in last month portfolio. That's first point. Second thing, when you talk about global market, let me very clear. Even from India perspective, we said that easy phase of bull run is over. We are in bull run. We are in decisive bull run, but we are in difficult phase of bull run. So obviously the strategy which was there in the easy phase of bull run has to be different. And if we are in the difficult phase of bull run, that's first point. Second thing you have to look at, our worry for India is actually on the lower side because India risk appetite is still rising. And so is the case with some of the emerging market. Worry from the global market is right now is more on the developed market side and particularly on the US side, where market obviously all-time high and everything is doing very well. Economy is also doing very well. But the challenge is that we are seeing some amount of complacency. The people are becoming slightly complacent. So we will look at our behavior analytics tools and we can say the Quant Complacency Index for US has spiked significantly, which means the probability of vulnerability is on the higher side. Okay. With that background, if I look at multiple data points also, when we talk about cross-asset, cross-market thesis, then we realize that the employed walls of various asset class in the early stages of inching up, which means the coming times can be more volatile as compared to what we have seen in last few months. That's so the global background is not going to be as conducive as it was in the past. However, India remains in a very unique situation. If I have to look at from India from a perception point of view or the perception analytics data, this clearly indicates that something has changed in India. Okay. So we say this decade belongs to India, maybe half century belongs to India. But what is very important to understand that no move is going to be linear. Okay. What is very important, how you manage your money through sector rotation, stock rotation, and if you can manage your stock selection and sector allocation properly and right allocation also, it's not like you identify a great stock, but you bought only 0.25% of the portfolio. So it's not going to make even rounding error difference also. So what is about is allocation. A lot of people get it right, but the allocations are wrong. So as a house of where we say quant, we quantify everything. I think this aspect is also important, how you construct and what weightages you give to this thing. So from that perspective, we are very constructive on India. We say it's one of the opportunity once retail investors should never going to miss it. This is a lifetime opportunity which is there. And with that background, we believe that one should remain invested rather than withdrawing money, but everybody has to reassess their risk appetite from the current level, their investment horizon. If you have long-term investment horizon of 5-10 years on the mid and small, we remain invested and maybe add. But if your investment horizon is small, then you have to relook or in terms of your schemes allocations.
Fair point. Sandeep, two questions with regard to management, and we've seen because of the analysis-based selection of schemes, the way that you've described the portfolio selection, there is a high degree of churn. You use opportunities to sell, and you're happy to churn. You're not stuck to a particular portfolio. Does that strategy and the strategy that you've employed so far become harder with the increase in the asset base? Because if you're talking about your small cap fund, you're now at what, 23,000 crore AUM. Can you utilize the same strategies that you used when you were much more nimble?
So I'll address, these are two very important myths, and I'm using the word, they are myths, nothing more than that. Okay. Somehow we have been taught in India, churn is bad. Churn means, high churn means no clarity of thoughts or confusion in your mind or no clarity. Okay. And generally it is linked with a negative connotation. Higher churn means not a great money manager. Okay. Now we are student of adaptive asset allocator and allocations, which where we try to understand the prevailing global macro environment, and based on that, we will decide whether it's a risk on phase or risk off phase, and what is the intensity of risk on risk off. Let's say very simple example: what food we can eat in Bombay. What food I can eat in Chandigarh and relish, I can't eat that sort of food in Bombay. So it's depending on the weather, climate condition, region, your food habit and attire, it's linked with that. Something similarly we say in the market, based on the prevailing macro environment, you have to decide your strategy. That's the first point. Second thing is very important, that churn actually is a very good thing, because if churn reduces my risk, okay, in a sophisticated language in the portfolio management, we call it rebalancing. In a very crude manner, we teach the concept of churn. Okay, in global portfolio management, you will not get this term called churn. Like private equity rebalance their portfolio in 5 years and 10 years. Maybe some very traditional long accounts rebalance their portfolio on a yearly basis. That asset allocator on the year and decide what the next year's strategy will be. Hedge funds rebalances their portfolio on a quarterly basis, and maybe trader rebalance their portfolio on daily basis. Okay, what is very important for us to understand, that rebalancing, since we live in a dynamic world and we practice dynamic style of money management, our rebalancing is also equally dynamic. Okay, and actually this reduces risk, and that's the reason if you sit down and analyze our analytics over the data, then you realize our performance is good, outperformance is extraordinary, and but what gives us satisfaction is that we are the best in terms of risk adjusted return. If you look at last 5 years data, our fact sheet, or even any tools you pull it out, you realize our risk adjusted return is across all the schemes, categories which we operate, we are actually the best, which clearly means that something right we do as a house.
Yeah.
And risk on risk of environment through VLRT framework really help us in capturing that.
Fantastic. All right. Sandeep, thanks so much for taking the time. Pleasure speaking with you. Look forward to the next one.
Okay. Thanks for calling us.